You are staring at a chart. It is 9:30 on a Tuesday morning, and the line is doing something it has no business doing, jagging sideways, then dropping, then spiking for no reason you can explain, then dropping again. You bought this stock because someone on the internet called it the next big thing. You believe them, and now you are sitting there in your kitchen, coffee going cold, wondering if you just watched 3 months of savings disappear between the time you poured the cup and the time you sat down. That is not investing. That is gambling with extra steps. And the worst part is not the loss. The worst part is the feeling underneath it. The quiet, exhausting wish that money could just be simpler. That somewhere out there exists a boring, mechanical, ugly little system that wakes up every single month and pays your electric bill without you having to do a single thing. No charts, no drama, no refreshing your portfolio at 2 in the morning. Just money arriving like clockwork because you built something and it kept running. That system exists. It is called a dividend portfolio. And most people who try to build one fail not because the strategy is wrong, but because they're building it with the wrong goal in mind. Here is what this is actually about. Most people come to dividend investing the same way they come to every financial idea, chasing a number. $1 million, $2 million, financial independence, retire early. The number is big, abstract, and so far away that the brain cannot hold it as real. So the brain quietly gives up, not loudly, not dramatically. It just stops taking the daily action seriously because deep down it does not believe the destination actually exists. The reframe that changes everything is this. Stop trying to build $1 million portfolio and start trying to replace your electric bill. Your electric bill is probably somewhere between $60 and $120 a month. It is a real number. You have paid it 100 times. Your brain knows exactly what it feels like. Now ask yourself, what would it feel like if that bill just disappeared? Not because you stopped using electricity, but because a collection of companies you own a small piece of sent you a check every month that covered it automatically? That is not an abstract feeling. That is a specific, tangible, emotionally real target. And the moment you shift from chasing millions to replacing one specific bill, something strange happens inside your head. The scarcity mindset, the one that whispers you're too late, too broke, too far behind, it loosens its grip. Because now the math is not impossible. The math is manageable. And manageable math gets acted on. This is where we begin. Before you buy a single share of anything, you need to understand what a dividend actually is, and more importantly, why some dividends are worth owning and others are traps dressed up to look attractive. A dividend is a portion of a company's profits paid directly to shareholders on a regular schedule, usually quarterly, sometimes monthly. When a company earns money and has more than it needs to run its operations, it can return some of that cash to the people who own it. That is the idea. Simple, honest, and centuries old. The Dutch East India Company paid the first recorded dividend in 1602. The concept has survived every crash, every bubble, every technological revolution since then because it is built on something real, actual earnings from actual business activity. The problem is that not every dividend is created equal. And learning to tell the difference between a strong dividend and a dangerous one is the single most important skill in this entire strategy. The first thing you check is the payout ratio. The payout ratio tells you what percentage of a company's earnings are being paid out as dividends. If a company earns $1 per share and pays 50 cents per share in dividends, the payout ratio is 50%. That is healthy. The company is keeping half its earnings to reinvest, grow, and protect itself during hard times. Now imagine a company earning $1 per share and paying 95 cents in dividends. That payout ratio is 95%. There is almost nothing left. One bad quarter, one unexpected expense, one economic slowdown, and that dividend gets cut. And when dividends get cut, the stock price usually drops at the same time. You lose on both ends simultaneously. As a general rule, for most traditional dividend-paying businesses, you want to see a payout ratio below 75%. For real estate investment trusts, which we'll get to shortly, the rules are slightly different. But the core principle holds. A dividend that the company cannot comfortably afford to pay is a dividend that will eventually disappear. The second thing you check is the dividend growth history. A company that has paid and increased its dividend for 10, 15, 20 consecutive years is communicating something that no press release ever could. It is saying, through recessions, through bear markets, through global crises, through rising interest rates and falling consumer confidence, we kept our promise to shareholders. We kept paying. We kept growing the payment. That kind of track record is earned, not manufactured. There is a group of companies in the United States called Dividend Aristocrats, businesses in the S&P 500 index that have raised their dividends for at least 25 consecutive years. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, Realty Income. These are not exciting companies. They do not make headlines. Nobody talks about them at dinner parties. But they have been quietly mailing checks or wiring deposits to their shareholders through every economic era of the modern age. That consistency is worth more than any flashy growth projection. The third thing you check is the yield. And here's where most beginners make their first serious mistake. Dividend yield is calculated by dividing the annual dividend by the current stock price. If a stock is priced at $100 and pays $4 a year in dividends, the yield is 4%. Straightforward. But here's the trap. A very high yield, say 10, 12, 15%, is almost never a gift, is almost always a warning. When a stock price drops dramatically, the yield appears to go up even if the dividend stays the same. So a stock that used to yield 4% and then collapsed in price might now appear to yield 12%. New investors see 12% and get excited. They buy. The company, still in trouble, then cuts the dividend. The price drops further. Those new investors are now holding a falling asset with a shrinking income stream, and they paid a premium to walk into that situation. This is called a yield trap. It destroys more dividend portfolios than any market crash ever has. A healthy yield range for most dividend portfolios sits somewhere between 3 and 6%. You want enough yield to generate meaningful income, but not so much that the market is screaming that something is wrong. 3 to 6% from companies with sustainable payout ratios and proven histories of growth. That combination is the foundation. Now let us talk about the actual structure of a portfolio built to generate cash flow. You do not want all of your dividend income coming from one industry. Industries have cycles. Energy booms and busts. Banks thrive in rising rate environments and struggle in others. Consumer staples hold steady during recessions, but lag during expansions. Technology companies are increasingly paying dividends, but are still more volatile. Real estate investment trusts offer some of the highest yields available, but respond sharply to interest rate changes. The goal is to build a collection of income streams that do not all go quiet at the same time. Think of it like this. Imagine your income portfolio as a rental property business, except instead of owning buildings, you own small pieces of dozens of different businesses across different parts of the economy. Some of them pay rent every month, some every quarter. Some are more predictable than others. But the collection as a whole keeps generating cash because not everything fails at once. A simple, functional dividend portfolio for someone starting out might look something like this. One layer of the portfolio comes from consumer staples companies, businesses that sell things people buy regardless of economic conditions. Toothpaste, dish soap, packaged food, toilet paper. These companies do not grow explosively, but they do not collapse either. Their dividends tend to be reliable precisely because demand for their products is nearly inelastic. People stop buying luxury goods during a recession. They do not stop buying toothpaste. A second layer comes from utilities, electric companies, water companies, gas distribution networks. Utilities are some of the most boring businesses on earth, and that is exactly why they belong in an income portfolio. They operate in regulated environments with predictable revenue. Their dividends are some of the most consistent in the market. And there is something almost poetic about owning shares of the electric company that sends you a bill every month. Your dividend income from that company literally offsets the bill they are charging you. That is the machine working in real time. A third layer comes from real estate investment trusts, commonly known as REITs. By law, REITs are required to distribute at least 90% of their taxable income to shareholders. That is why their yields tend to be higher than most other types of companies. REITs own and operate income-producing real estate. Apartment buildings, office towers, shopping centers, data centers, cell towers, hospitals, warehouses. The dividends flow from rent payments made by tenants. Some REITs, like Realty Income Corporation, actually pay their dividends monthly rather than quarterly, a structure that maps almost perfectly to a monthly expense replacement goal. A fourth layer, for those with a longer time horizon, can include dividend growth stocks in sectors like healthcare, industrials, or financials. These may yield less today, 2 to 3%, but they tend to grow their dividends aggressively over time. A stock yielding 2% today that grows its dividend at 8% annually will be effectively yielding a much higher percentage on your original investment within a decade. This concept is called yield on cost, and it is one of the quieter compounding forces in the entire strategy. Now let us talk about the actual process of building this, starting from nothing. The first step is not to open a brokerage account. The first step is to calculate your replacement targets. Take your monthly expenses and write down only the fixed, non-negotiable ones. Electricity, internet, water, phone, groceries. These are your primary targets. Pick one, the smallest one, and commit to replacing it entirely as your first milestone. If your internet bill is $65 a month, that is $780 a year. At a 4% dividend yield, you would need roughly $19,500 invested in dividend-paying assets to generate that income passively. That is a specific number. That is a real goal. That is not a vague promise about someday retiring on a beach. The second step is to open a brokerage account with no trading fees. Multiple platforms now allow investors to buy stocks and exchange-traded funds with zero commission per trade. This matters enormously when you're starting small, because every dollar that would have gone to fees now goes to building the portfolio. The third step is to start with diversified dividend funds before individual stocks. There are exchange-traded funds, commonly called ETFs, that hold hundreds of dividend-paying stocks inside a single investment. Funds that track dividend aristocrats. Funds that focus specifically on dividend growth. Funds built around high-yield REITs. Buying a single share of one of these funds instantly gives you exposure to dozens or hundreds of companies, which means your income stream is diversified from the very first purchase. This matters when you're starting out because you're still learning, and concentration in a single stock during the learning phase is how beginners take unnecessary damage. As your knowledge and confidence grows, you can begin adding individual positions in companies you have researched thoroughly, checking payout ratios, reading earnings reports, understanding the business model well enough to explain it to someone else. The portfolio evolves over time from broad funds to a curated blend of funds and individual positions that reflects your specific income goals. The fourth step is to automate everything you possibly can. Set up automatic contributions. Pick a day each month, the day after your paycheck clears, perhaps, and have a fixed amount transferred from your bank account to your brokerage. Not whatever is left over at the end of the month. A committed, automatic, non-negotiable contribution made before any discretionary spending happens. Even if the amount is small at first, the habit is more valuable than the dollars in the early stages. Set up dividend reinvestment for every position where you are not yet living off the income. Most brokerages offer automatic dividend reinvestment, meaning every dividend paid by your holdings is automatically used to purchase more shares of that same holding. More shares means more dividends. More dividends reinvested means more shares again. This is the compounding engine, and it does its most powerful work during the years when you are not watching it closely. The fifth step is to stop measuring your portfolio by its total value. This is subtle but critical. When you measure a dividend portfolio by its total value, the number you see when you add up all your holdings, you are using the wrong metric. The number goes up and down constantly with market prices. It will terrify you during corrections. It will make you feel rich during bull markets, and make you feel foolish during pullbacks. Neither feeling is useful. The right metric is annual dividend income. How much cash will this portfolio deposit into my account over the next 12 months? That number is far more stable than total portfolio value. Even during significant market downturns, well-constructed dividend portfolios continue generating income from companies that have not cut their dividends. You may watch your portfolio value fall 20%, but your dividend income may fall only 3% or not at all. That stability is what allows you to hold through volatility without panicking. And holding through volatility is where all the long-term wealth is actually built. One more thing needs to be said clearly, because it is the place where most people stumble hardest. There will come a moment, probably within the first year, when you look at your portfolio and feel almost nothing. The contributions feel small. The dividends feel trivial. Someone at work will mention doubling their money on some speculative stock in 3 months. And for a moment, your patient, methodical, boring by design strategy will feel like a mistake. It is not a mistake. What they will not tell you is that the same person who doubled their money speculating will, with near statistical certainty, eventually give most of it back. The market has a way of reclaiming money that was never earned through fundamentals. But the dividend from a company that has paid and grown its distribution for 30 years, that was earned. It was earned by businesses serving real customers, making real products, operating real supply chains. That income is built on something that does not evaporate when sentiment shifts. Your electric bill does not care whether the market is up or down. It arrives. It expects payment. And the portfolio you're building is designed to be there waiting for it, quietly, reliably, every single month, while the rest of the world is busy staring at charts it does not understand. The machine you are building is not glamorous. It does not have a compelling story for dinner conversations. It will not make anyone jealous at a class reunion. But 10 years from now, when the portfolio has grown past the point where it covers your utilities, then your groceries, then your rent, then your entire monthly overhead, and you realize that the income arriving in your account every month exceeds the amount you need to survive, you will understand what real financial freedom actually feels like. It does not feel like a number on a screen. It feels like a bill arriving and not caring. That is the goal. That has always been the goal. You just needed someone to say it in a way that made it real enough to start. Start now. Start small. Start with one bill. Build the machine. Let it run.